Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity.
This is Jason Buck with Mutinyfund, and I'm sitting down with Brett Nelson of Sirtezza Asset Management. Sirtezza is an algorithmic trader that takes advantage of mispricing along the VIX curve term structure to create, absolute return value trades along the VIX curve. Now, what's interesting to me about Brett is he's traded the VIX longer than anybody I know. Quite frankly, nobody could trade longer because he's traded the VIX since the inception. But we'll come back to that piece. And I want to start off maybe just talking about, his childhood, the middle school and high school years and going around to different math competitions and trying to hide the fact that he was a math nerd. So if you could tell us a little bit about that, Brett, that'd be a great place to get us started.
Sure. It's a little funny that, people that grow up in the current age, they maybe don't realize this, but being smart and being into nerdy things wasn't cool back in the 90s and 80s. And so being an 80s kid and growing up in that era, it definitely wasn't cool to be a math enthusiast or a mathematician. And so I kind of had to be a closet math nerd. And I joined some math programs when I was in about sixth grade. And because one of my teachers came to me at the time and said, "Hey, I really want you to separate yourself from the rest of the students here and pursue this thing that you're obviously quite good at." So I pursued that at a low level at first in sixth and seventh grade, and then started getting into regional, state, and national competitions. To put it in perspective, you're talking about doing what you would consider as intermediate level college mathematics in middle school, and then obviously once you hit more of the high school years, you're doing advanced mathematics at that point and trying to compete. So that's really what spawned my interests and my genesis in the financial markets.
And so, having that mathematical background, when then you first start learning about the financial markets, what really caught your attention from a mathematical perspective? What was really that impetus? What was that trigger? What was that aha moment where you're like, this is where I can use applied math and use that praxis in real life?
Well, first off, I always liked the concept of making money. I was entrepreneurial in nature anyway. So I was trying to start little businesses when I was 12, 13 years old, and not like your typical lemonade stand type stuff. I was doing more like wholesaling and things like that, finding wholesale distribution stuff and trying to resell it at market prices and things like that. And that was when I was quite young. And so that gives you a little bit of an insight into the type of person that I am. And
natural arbitrageur, right? That's what you're doing.
Really an arbitrageur. So
exactly for the start. But just like you said, you were a math nerd when it wasn't cool to be a math nerd. We're both old enough to know we were entrepreneurs when it wasn't cool to be an entrepreneur. Now it's really cool to be an entrepreneur. So So sorry, I interrupted there. So going from wholesaling, what was it? What the entrepreneurial side taking you into markets?
Yeah. So with a focus on just financial interest in general, then you have to realize that now we're getting up into the mid-90s. In the mid-90s, the internet was becoming a thing pretty heavily, and particularly platforms, online trading platforms, had become a thing by the mid to late 90s. And you had really broad access cheaply to direct access trading platforms, interactive brokers, for example. And obviously, being as young as I was undercapitalized. So I found myself in options, because what do you do if you don't have capital, but you want to do more sophisticated financial, arbitrage type mechanisms? And I landed in options, and I started to obviously flirt with the different types of positionings within options, and specifically, whether you want to actually manifest a directional opinion with options, or whether you're looking deeper into the mathematics. And it's looking deeper into the mathematics is where I got lost in it, and finding the alpha that actually exists within that market.
Yeah, we always like to think about options as it provides you with a finer paintbrush. There's a lot of things you can do with options that you can't do with other instruments. So what was the fascination for it? It sounds like you weren't interested in the directionality, but maybe trading the Greeks or thinking about different ways to pair off the Greeks against each other, or how did you look at it?
Absolutely. Yeah, so I made my fair share of directional trades. And then once I got far enough into the math, when you dig deeper, you start realizing that what you thought was a directional trade in options actually wasn't. When you fine tune it and you do some attribution and everything, you actually start realizing that most of the alpha that you're picking up is due to Vega, right? And I started to really focus in on the Vega component. And a lot of people will say, well, I'm gamma scalping and things like that. No, and in actuality, you're not gamma scalping, you're Vega scalping, even if you think you're gamma scalping, okay? Because Vega affects gamma. So the alpha component that's inherent in the alpha that's inherent in the Vega component was fascinating to me. But then you have to jump into the idea that, in fact, forecasting variance and forecasting vol is one of the hardest things to do mathematically. It's hard enough to predict direction or to forecast direction accurately, but to forecast the volatility or the variance of the direction is much more difficult. And so that's really what led me down this path and saying I can utilize an inclination toward mathematics to actually create much more sophisticated positioning than anyone else that I was around was doing at the time. And obviously, being in Utah, I wasn't surrounded by Wall Street types. So I spent just an absurd amount of time on quant forums, mathematic forums, trading forums, and trying to figure out who was doing what I'm doing. And was I by chance pursuing a path that was incorrect, or was I actually just doing something that was uncommon but not incorrect, right? And by the early 2000s, I had found a small group of individuals that were more vol focused like myself, and we were forced into trading options to extract Vega, but that wasn't really ideal. And everyone that was doing it, and those who are honest that still do it, actually recognize that in many cases it's not ideal. Because if you're trying to be purely focused on volatility, options might not be the best way to do that, right? But if you're willing to, take on some directional exposure and some theta exposure and things like that, then maybe options are for you. But for pure volatility, there didn't exist a product at the time. And so we had this core group of individuals that spent a lot of time just isolated from the rest of the public and saying, how do we build these algos and how do you forecast volatility correctly, right? And unfortunately, you can't buy a book on that. So it was really us doing what we could do with the mathematics that we knew. And amongst that group, I was more mathematical in nature and others were more finance-based, some that were, in prop groups in Chicago. But as luck would have it, 2004 came around and the CBOE came out and said, hey, this VIX index that you've all been using is now going to have futures. And that was the defining moment.
Yeah, I was building VIX Arbitrage or intramarket spread models on the VIX in 2010, 2011. And I thought I was early and the liquidity is low. I can't imagine 2004, right? And so part of that is part of that is you don't have the liquidity, but also in a nascent market like that, there's a lot of opportunities to take advantage of if you can model better. And when they launched in 2004, it was a different VIX index. What year did they switch to to now using the full spread that we use now?
Well, it's not just the different VIX index. It was that the popularity, the liquidity really had to be there for VIX to be a usable instrument, right? It really didn't do us a whole lot of good mathematically to say, you and I are the only two trading it, and I'm trading against you for bragging rights. And for example, we might have an April contract and a September contract and maybe a December contract. That's not entirely helpful, right? In actuality, to really model variance appropriately, you really need a term structure. And the term structure really didn't evolve consistently until later in 2006. So sometime around like October of 2006, right? And really what led to that was the options came online for VIX a little while after the futures did. And the options actually gained in popularity faster than I thought they would. And we dabbled in the options as well. And I was doing spread trades and options and things like that. But really what the beneficial effect was that the liquidity of both and the depth of both books actually increased dramatically. And so you actually ended up by October of 2006, you actually had what we'd consider a usable term structure that could be modeled.
And part of that, though, originally they used them much more at the money strikes, and then eventually, though, they switched to like out of the money strikes.
And in 2004, so the VRO and
right, VRO.
Like
Yes.
So they were focused very much at the money before, and now it's a much broader selection. In either case, we still have the uniqueness of VIX, and that most people don't realize. I like to call it the structural alpha of the VIX markets. And the reason I say they're structural alpha is because whether they were using the more narrow at the money strikes or a much broader swath of further out of the money strikes that they do now, it really doesn't change the fact that you can't replicate the synthetic in VIX. And because you can't replicate the synthetics, there's no physical to arb against. And so now you've got a structural condition mathematically where the prices of the futures are allowed to wander much further than they would in a normal, physical commodity market.
Great. And just to go back for a second, how would you describe VIX to the layman instead of like maybe 30-day forward variance, maybe tying it to the options on the S&P or on the SPX? How would you describe VIX, the VIX index, before we get into the term structure? Yeah,
really simply, VIX is actually best viewed as, even though it represents an annual number, so it tries to suggest that it's supposed to be telling you how much fluctuation up and down in an annual term the S&P 500 should see. But that's not entirely accurate or helpful. So for example, if VIX is at 20 right now, right, it's near 20 as we speak. It's not accurate to say that it's predicting or forecasting a plus or minus 20% fluctuation within the next year. That's not helpful at all. And that's not what it is. What it actually is closer to most accurately is what type of daily fluctuations do we expect in the market right now? Okay. And once you annualize out that, you're getting more close to what VIX is representing. But so basically what you have to do at the VIX to get a little bit more technical is to say, what is this number that it's stating, right? Now bring it back into what the representation of that is in daily terms. So is it saying there's going to be a 0.5% daily fluctuation typically? Or is it more like 3%? So if you go back to, for example, March of 2020, and you're seeing VIX at 80, VIX at 85, things like that, it's not really saying plus or minus 80% fluctuation in the market. What it's saying is plus or minus 7% daily fluctuations or 5% daily fluctuations, which is wild in and of itself. But you remember, if you go back to that period, that's exactly what we were seeing. So the representation by VIX actually wasn't far off of the daily fluctuations we were actually seeing in the market. So that's really what it is. If you kind of calculate out the number a little bit, is telling you how much per day would you expect the market to fluctuate.
Perfect. And let's go back. So 2004, they launched the VIX products on CBOE. You start trading those products. When do you decide, I can make a business out of this and I can go off my own and I can start a fund around this idea?
That wasn't until 2010, actually. The landscape changed completely again in 2008, because 2006 said, I can model this. 2008 was the financial crisis, and suddenly VIX became the darling of the markets because all the institutions and everyone else out there was trying to basically say, this VIX instrument is anti-correlated to the markets and perhaps a better hedge than the traditional products like puts and things like that we were using. Right. So institutions started piling into VIX and it became incredibly popular. And if you remember, the volume in VIX was, tripling every year, sometimes quadrupling every year. And during that time, it was still pretty thin by market standards. And there was a lot of alpha coming off of it. And we were all making a lot of money if we were familiar with it. But there was an inclination to say, this isn't an institutional product. This can't be scaled. This can't be offered publicly. And we were seeing the amount of inefficiency we were seeing was obviously not going to continue, right? So it wasn't really realistic to think that we would be able to have a public offering off of that, right? But by mid-2010, I was finishing my algorithms and the liquidity and volume had continued to scale up. And I said, hey, maybe this actually will be something that can be offered. So I finished the algos and kind of went into a dedicated prop account for the next 12 months to say, how will this turn out in real time with no other focus, no other input, and no continual altering of the strategy, right? And it went fantastically well for 12 months. And I started to form Sirtezza Asset Management. And by January of 2012, we launched to managed accounts, and that's essentially the beginnings of the company.
And as you said, you had that entrepreneurial itch, or you were always an entrepreneurial minded person, but that's, you were trading the VIX for a long time, but it takes a lot to build that confidence to make that leap, though, to go from your prop account where you're your client, so you understand the deep mechanics of what you're doing, so you can handle drawdowns, et cetera. How nerve-wracking was it to actually go to managing outside money with the SMA structure and then eventually a fund structure?
Well, it wasn't that bad actually, because I sort of eased my way into it. We only really started managing. I managed for a couple, more like friends and family. And only with like a handful of millions, so like a few $1 million, and that allows you to at least not jump in with both feet necessarily, and really make sure that it's not that the model breaks in a lot of those cases. It's just that someone isn't capable mentally of managing outside money, and especially larger amounts. You really a person to manage a portfolio, especially large portfolios, really needs to be able to disconnect from the dollar values, right? You really can't consider what it was like to trade your own account and watch the dollars fluctuating, and then suddenly daily swings are in the millions. You have to be able to be the right kind of person that can handle that, right? And disconnect.
It's fairly sociopathic in a way. It's fairly sociopathic in a way, right? Like you have to think about
it really is.
Like gambling chips or whatever, but that's actually the proper way to have a fiduciary responsibility, though. You have to think in percentage terms, is essentially.
Yeah, percentage terms, and then the harder thing is actually to not just think in percentage terms, but to not consider what any fluctuation might mean to the revenue that you create for yourself, right? You cannot make decisions based on, the fluctuation today just took money out of my pocket in terms of fees or something like that. You have to turn that off completely and say, the model is the model. If there's no reason to think that the model is broken, then don't think that the model is broken, and don't make decisions based on, what your financial situation might be.
Exactly. And I know you've modeled back to the 87 crash, but as you know, it's extremely difficult to model VIX, and especially, as I always say, I don't really trust a lot of backtests beyond like 2010, just because, like you said, it was such a nascent market. We didn't have that liquidity before the ETPs started becoming online and becoming real traded. And because that vol surface is so undulating and the real money players are changing, like, how do you think about that? It's like, it's one of the hardest things. Everybody's like, can you backtest this VIX strategy back to 1900? You're like, no, you can't. And they're like, why? Like, I can do it with stocks and bonds or whatever, but you got to speak to that of like how it's so hard to model or backtest with any sort of VIX strategy.
Yeah, I mean, really, a lot of people say, we've taken our VIX strategy back to 2005 or something like that. And I'm like, okay, first of all, let's be real. It wasn't until October 2006 that there was even consistent pricing within VIX. Okay, so at earliest, it'll start there. Second thing is, any of us that were trading it prior to about early 2010 is about the period. We know how inefficient it was. Okay, and there were inefficiencies that weren't just mathematical inefficiencies or some type of like legitimate arbitrage opportunity. It was obviously a lot of players entering the market that did not know what they were doing and were giving away money, right? So I would say to anyone that's looking at historical returns or back tests that are back into the 08-09 period, big grain of salt there. We actually refuse to take ours back that far because I know what the market was like. So, and then if you want to go back even further and you say, I want to model this clear back into the 90s or into the 80s with the old calculation on VIX, and you can say, I can tell you that in the crash of 87, VIX, quote unquote, the VIX index printed over 125, right? Something like that. But you're saying, I don't know how terribly useful that is because I still don't have a representation of how I would have been able to monetize it or capture that value. Like, what do I do when I still don't have an indication of what correlations there might have been in the first or second month futures? So really it's nice to see how far the index values can go, but you have to be super conservative on what you would actually think that you could monetize out of that.
Yeah, there's a vast difference between the actual index values and actual term structure of the actual contracts you could trade.
Absolutely.
And the liquidity and the spreads and everything on that. So, we kind of left off. Let's kind of go back again a little bit. So you launched Sirtezza. What was the original thesis, and has this thesis continued to this day? And how did you look at what was your primary strategy for trading VIX term structure?
Yeah, the thesis actually hasn't changed really, and the reason for that is that the origins of my VIX trading gave me a pretty broad perspective on what was the appropriate way to utilize VIX. And so for perspective, the primary mechanism that other small group that I was working alongside of, their primary mechanism that they were going towards was what you would call the risk premium trade, right? The short vol trade. And even back then it was very, very juicy and incredibly consistent. And I found myself on the other side of their trade a lot. That's why I kind of split off and started doing my own thing, because it was weird because I was on the other side of their short vol trade a lot, but not because I wanted to be long vol all the time, but I could see the problematic nature of the short vol trade and how difficult it was to control in certain events. And then on the other hand, I wasn't necessarily trying to express long volatility bias all the time, although all of us would admit that if there was a way that we could just be long volatility all the time and make as money as consistently as the short vol guys, we would love to do that. But that's just not realistic. And so I really had to jump in and say, there's a thesis on this market that says it's not about the direction of vol. It's not about being long or short. There actually is structural alpha in this market. It is unique. There is no other instrument like it. And the characteristics that make it unique are a dream for a mathematician. So I can exploit that and I can jump into it and say, my thesis on it being an inefficient product and how to exploit the inefficiency hasn't changed. Although I will say over the years, we've gotten much better at it.
And so how do you, not without giving too much away, how do you think about the inefficiency of it? Is it, part of the term structure and having that roll yield creates unique opportunities, especially if you're, maybe picking off some of that left tail and then having a bias towards the right tail in explosive environments? What is that? What is the unique structure of the VIX markets that allows for those opportunities?
Yeah. Well, first, let me tell you a couple characteristics that VIX has that nothing else has, right? It's non-trending, right? It's very difficult to deal with something that trends. For example, the S&P 500 trends higher over time. It's undeniable, right? Inflation pushes it higher, productivity increases push it higher. And so you're looking at it and saying, as a mathematician, I have to then play some nice little mathematical tricks to eliminate the trend before I can actually find any useful data in it, okay? VIX doesn't have that because VIX doesn't just simply drift higher over time. It actually drifts horizontally over time with spikes up and spikes down, but it always seeks back to that, roughly that mean value, right? Which is exactly what it's designed to do. So that makes it really nice to work with to begin with. And then the other thing is that when you talk about, the explosive events to the right side, there's no left tail in VIX. And there's a really fat, what we call a really fat right tail, which means, VIX can't really go below 9 for any reasonable period of time mathematically, but it sure can go clear up to 100 in a hurry, right? And yet, and normally when something is between 10 and 100, you would say, okay, where's the mean? Is the mean around 50 or is the mean around 45 or something? And no, in this case, the mean is really, or I would say that the mode for a low vol environment is about 13, which is very, very close to that that bottom, that floor. And so you're saying, oh, so now there's a virtue of us saying we don't have to protect against certain types of moves if we position ourselves correctly, because there is no move in that direction, right? So you can be kind of single directional in your protection, right? And then once you've identified that, you say, the uniqueness of what I talked about before, when you say every other market that has futures, whether you're talking cattle or grains or anything, financial futures, there is always a physical, right? You can buy the physical, and if the futures prices get too far away from what that fair value is, arbitrageurs will come in and push them back very, very quickly. And so they maintain this really tight range. VIX is unique in that it's impossible to create that physical. So you can't buy the VIX index. And even if you could buy the VIX index, it wouldn't be particularly helpful all the time. And so you're actually dealing with futures that can vary. They can just, I like to say, they wander around what you might consider could be the fair value. You notice how uncertain that is, that statement. It's like they wander in a wide range around what maybe probably might be the fair value, because no one can actually say what the fair value of the future is. Okay? And that's what I loved about it, because you say, suddenly you're in a situation where you realize, hey, a lot of these big institutions out there, they have massive long equity portfolios, billions of dollars that they have to put to work. And when they put that to work, they do so with long stock, right? And they have to add value to their clients. So what they do is they say, oh, we're going to buffer the downside. And how do they do that? Well, they come out and they start buying puts, okay, put options. And when they buy those put options, they typically do it, in my experience, in a relatively what you would call an unsophisticated manner. In other words, they'll do a put buy once every quarter, let's say. And when that quarter's over, they get rid of those puts and they put new puts on. And they have a budget, something like 2% a year that they're willing to spend on put buy, okay? And that type of indiscriminate put buying leads to alpha within VIX. The reason for that is because they don't care if VIX is at 17 or VIX is at 16 and a quarter. They don't care. They just need their puts, right? But someone who comes in like us, we say we absolutely do care about the difference between 16 and a quarter and 17, right? And we know whether there's been some herd mentality or just some institutional pressure in one direction or another that has pushed a certain VIX contract off of. You can't say they've pushed it away from fair value, because you don't really know where the fair value is, but you can say they've pushed it seemingly to the extremes of what could be considered the real fair value. So it becomes highly unlikely that the current fair value is the accurate fair value.
And I want to touch on something you said just a little bit previously too. It's like, VIX doesn't trend, but it mean reverts or it spikes or clusters. So as we know from our Mandelbrot, it's clustering or it's mean reverting, and you don't really know either way. And as you alluded to, a lot of times, like people say VIX has a bimodal distribution. You have a low vol environment or high vol. I almost say it's almost like a trimodal distribution, because then you have the spikes as well. Obviously, they usually mean revert pretty quickly, but you have like a low vol environment, a medium vol environment, and a high vol environment. That's like a trimodal distribution. But that offers different opportunities. And when we're talking about the actual VIX index or the spot VIX, that's one way to talk about, like you were saying, it mean reverts and it trends sideways, but that's the actual index. And then you overlay, like you were alluding to, the term structure of those VIX futures. So that can give you opportunities where maybe you're playing that left tail, where you have that barrier of lower volatility. So you have that term structure that's rolling down, where you can maybe bring in some income or play that left tail side. And then you could be putting on trades at other parts in the curve that are like that long volatility, or looking for that big spikes, or vice versa. You could do front month to back month and or switch those ratios around. How do you think about, you guys use a very dynamic way of looking at putting on that term structure calendar trade. Can you talk a little bit about how you look at that, over whether, depending on which volatility environment you're in, or what kind of indicators or flows do you look at depending on how you'll assess that trading parameter?
Sure. The way that we do it is we take a really universal approach to it, right? And by that, I mean, we come in and we say, what data do we have at our fingertips, right? Let's say 50, 60 years worth of S&P 500 data. We've got, new methodology VIX data going back to 1990. We have all the VIX term structure data going back, at least usable back to October 2006. And so we bring all that in, plus a couple other things, and we say, we're going to create an exhaustive data set, and we're going to run what you would consider an incredibly complex and sophisticated Monte Carlo simulation. So for those who aren't familiar, you're basically saying we start at time zero, at now, and we say, what possible moves could this future make in the next day, right? And the thing about a lot of Monte Carlo simulations is they step from one day to the next day to the next day. They're doing it in a pretty, what you would call a static fashion, a static probability fashion, which doesn't resemble volatility at all. Volatility is very dynamic. And so what you actually have to do is you actually have to say, I've stepped forward a day. Let's say I've run 10,000 simulations for one day, right? So now I have 10,000 new data points that are possibilities of what could have happened over a 1 day period of time. I can't simply step to the next day. I actually have to step backwards now and say, let's recategorize what now looks like for all 10,000 of those points, and then step 10,000 points forward for each one of those 10,000 points. So what we call it is more of like a regime fit, a micro regime fit, right? And you say, you have to realize that the universal set of data for VIX is not always applicable all at once. And the reason for that is you talk about volatility clustering as a prime example. It does you very little good to think that you're going to get an outcome tomorrow that is exclusive to a low vol environment when we're currently in a high vol regime, right? And so don't count on those outcomes, and don't weight them heavily in your probabilistic outcomes, because they're not going to happen, right? And so you have to actually regime fit very, very precisely or accurately. And then once you regime fit, you have to bring that into every step of every 10,000 simulations that you do, right? And so step forward one step, 10,000 data points, and for each 10,000 data point, to each of the 10,000 data points, you have to re-regime fit and then step forward again and then re-regime fit, and it goes to millions and millions and millions. And you create an exhaustive look of what could possibly happen all the way along the curve at every point along that futures curve, right? And then you say, where's my exposure, right? And you figure out what the most probabilistic outcomes are. And you say, we categorize everything in terms of what we call expectancy ratios, right? So basically, what is my expected profit or my expected loss on this specific trade for a given unit of risk, right? And we do that for all possible combinations. So we're looking at saying somewhere in there, there's going to be an identified probabilistic inefficiency. And once we've found it, it gets even harder, because then you say, okay, we found something that actually is representing an opportunity. Now there's tens of thousands of different ways that we could trade that. We could buy one contract per million, buy two contracts per million, buy one now and wait for the price to improve, and buy another one at a slightly improved price. There's any number of ways you could trade it, which we call the methods, right? So then you have to have an algorithm that comes in and optimizes the method and says, first identify the inefficiency, then optimize the method around that one trade, right? And then let the trade work.
Sorry to interrupt you. As part of the methods, are you taking into account the steepness of the curve, whether you're in steep backwardation or shallow, and vice versa for contango? If you're in steep or shallow, is that overlaying on your Monte Carlo simulations to then figure out that best trade and addressing the methods through the steepness of the curve as well?
Yeah, so the slope of the curve is one variable. It's one input in this regime fit, right? So if the curve is inverted, the curve might be inverted with spot VIX at 20, right? With the index at 20, the curve might be inverted. Or there's another time where, for example, like more recently, where spot VIX is at 25 and the curve is not inverted, right? And so you can't look at it and say, oh, just because VIX is at 25, we're going to do this all the time. You have to say, okay, what does the curve actually look like with VIX at 25? And how many circumstances do we have that are like this, right?
And then so going back to the methods, so you run through the methods. Give us like some examples of kind of like what trades you're putting on, or like what kind of probabilistic trades it's giving you, and if you're putting on different trades that are kind of, they may be battling or offsetting each other, or are you thinking about the ratio of those and what's the optimal ratio? How much are you hedging it out? All those little nuances to actually the trade construction.
It's interesting. You bring up one interesting point, is that there are possibilities you might have two trades that are kind of pinging on your system there and saying both of these are good trades, and they might actually be contra to each other, right? And then there's always this question of, should they both be employed? Because both have positive expectancy, and yet they do offset each other slightly. And what you realize in VIX is that, yes, in fact, they both can be employed, because the VIX curve doesn't necessarily behave the same way. It's not necessarily creating a wash. There's a time difference. There's a time period difference that you're looking at. And so both actually can be exploited at the same time. So you might actually be long and short vol at the same time, right? At different points along the curve. And for us, I will say in general, we don't really love the front month contract, not as a rule, but as a general preference. And the reason for that is when you start categorizing things in terms of expectancy, which some people, let me get out of the technical term expectancy and get into what someone would call more like a risk multiple, right? Like how many dollars are you expecting to gain per unit of risk? And what happens is there's a lot of inefficiency in the front month future at the very front end of the curve. And there's a lot of opportunity to make absolute return there. That's for certain. The problem with it is once you've run these exhaustive data sets and these simulations, you realize that there's a disproportionate increase in the risk in that zone. So let's say in the second or third month or the middle of the curve, as we say, I can only make $2 per contract trading, right? And I'm like, well, that's not anything close to the $10 that I could make in the front month future, right? And then you say, oh, actually, my risk in the middle of the curve is actually only like $1.50, whereas my risk in the front month is $25, right? And so you're like, yeah, it's a disproportionate increase in risk there, and we're not going to accept lower risk-adjusted returns simply because we can get higher absolute returns. So that's really, we kind of, I won't say that we completely avoid the front end of the curve, but we have a preference to stay away from it. And you'll see us adjusting our positions out once we start crossing over into the front month.
Yeah, it's not as sexy, but you get better risk metrics per unit of risk if you're second to third, fourth month. So if you're playing in the midterm of that term structure, are you putting on calendar spreads directly? Are you putting on triangle spreads? Like what kind of trades are you putting on?
Think mostly in terms of calendar spreads and butterflies. What most people would call a butterfly. We do have, it depends on the regime at the time, but you'll see us in a lot of calendar spreads. They might be long, they might be short. We have a particular affinity to what you would call a ratioed spread or a back spread, right? So for example, there's some really unique things you can do with VIX in that you can take, everyone knows that the short vol trade is quite consistent and highly probable, right? But that it has blow up risk. Once you've nailed down the characteristics of how vol operates, in other words, for example, if I were to tell you that this curve that we're talking about, if everyone envisions that nice, beautiful curve where it's a little steeper on the front end and flattens out to the back end, and then that with a volatility spike that can invert and go up so that the front end is inverted quite steeply and the back end is flatter but lower. If I were to tell you something like, as a little insight, it doesn't make a smooth transition between those shapes. So for example, what might happen is that you'll have this nice, beautiful, what we call a contango curve, right? This upward sloping and flattening curve. And if I told you that actually tends to shift first, and then it pivots and flattens out. So basically more shifting with not really a whole lot of change between the individual months, shifting, then it pivots. In other words, not gaining a whole lot, but the front month is coming up to flatter stance, then goes inverted. And then once it's inverted steeply enough, it goes into shift mode again and just starts shifting completely higher. Now, if I say that to someone who actually deals with the VIX, they say, oh yeah, that is how it behaves. And if we go back into March of 2020, for example, or back into 2008, you'll notice that, it inverts quite rapidly. And then once it's inverted far enough, the entire curve starts to shift up. And you say, oh, well, that means that with different spreads, I can exploit this tendency for the back month of the spread to actually continue higher while the spread doesn't continue to widen any further, or the widening is minimal relative to the increase. And so this is where different types of ratios might become kind of fun to play, right? Because if you know where to expect those behaviors, you say, I can create something that at its core is actually a short vol trade, and it gets all the benefit of that consistent gathering of risk premium, as we say, and the high probability of profit and all of those virtues. And yet it's a little bit heavier on the back leg, on the long vol leg, right? So if you know how to do it in the right proportions, you're saying the moment that I'm going to start to get in trouble on this calendar spread, that back leg is going to kick in and give me a safety net. And not only that, but if it keeps going, that back end is going to become the return driver, right? So you end up with what we call a smile return curve, right? Where if 90% of the time VIX stays in its low mode, its calm mode, right? And you're in that that ratio spread, you'll basically just gain the risk premium, the short vol trade. And then there will be a little bit of a dip where you'll go, negative P&L on that. You'll go negative expectancy in the middle of that. And then on the back end, it just goes parabolic because that long vol kicks in. You become crisis alpha at that point.
Yeah, and just to use a toy model as an intuition pump, the idea would be of a ratio back spread like that. You could be short the third month, and then you could have put on 2 or 3 contracts of long the 5th month, and whatever your ratio is that your model creates. So that's why I'm just using a toy model. But that gives us gives the audience an intuition of what that trade looks like. But even better, like you're saying, as that curve moves from contango to backwardization, goes flat, and kind of rises and lifts in both directions, it gives you time also to adjust that trade too, I assume, as well. Like you can start taking off that, your closer to position, your short vol position, and really, like you said, ride the wave of the multiple contracts of the back month. Is that the way you look at it?
Yeah, that's the way you look at it. So there's any number of ways you can adjust it, right? Because on the one hand, it's very rare. We don't pick bottoms and tops, right? So it's almost unheard of for us to say we're going to take a full-sized position from day one, right? We almost always have a partial position on with the algorithm saying that there is a reasonable probability that the prices improve, and we're going to be able to add at a slightly improved price. So kind of like a dollar cost averaging for those who have done that in stocks before. But once you've averaged into the right price, you can always add more exposure or take off exposure in what you would call unit chunks, right? Or you can actually change the actual back spread ratio to your point of saying, oh, well, I was too short third month, and then I was 5 long 5th month, right? That could go to a 2 to 4 ratio or a 2 to 6 ratio, depending on whether or not. And that I can, without divulging too much, I can tell you that you can get into situations where the beauty of a trade like that is, for example, let's say that you have 2 short 3rd months and 5 long 5th months, right? And you're saying the market has moved substantially, but this trade hasn't particularly moved because it hedged itself off really well. But if you do a quick attribution, right, and say, why has the market moved substantially, but the trade P&L is actually relatively flat? What that means is that a portion of that trade has moved substantially, and then there's a portion that's left. So then you have to run your analysis and say, is it time to take off the portion that has benefited substantially? And then you've got not necessarily quote unquote free, but you've got basically an easy entrance into a reversion trade from that point, right? Which actually happens quite frequently, where you say the short volatility component of this trade is played out, right? You take it off and you're left with a long volatility trade, which happens to be just the time that you should be long vol. So,
which serendipitously perfect time for long ball positioning. And so part of that too is like, I assume that you're constantly adjusting the volatility of those different points in the curve for your ratios, and you're looking at those on a daily basis. Like, has anything changed? Do I need to change these ratios around? And in a way, going back to the very beginning of the conversation when you said people aren't necessarily gamma scalping, they're Vega scalping. That's a way to almost Vega scalp the position as it moves around on you on a daily basis.
Absolutely, that's exactly what it is. Yes, we're Vega scalping the position constantly. And sometimes we're not necessarily Vega scalping it. We're just adding to size as pure money management, right? Pure money management techniques are employed all the time, but then there's the Vega scalping component in addition to that.
And then you said, and then right around that time, it might be the time to put back on a mean reversion trade. But how do you guys think about, we've had a lot of times quants are just looking at mean reverting pairs trades, and they say, oh, this is in the 90th percentile, so it's high probability it's going to mean revert, and then that spread just absolutely blows out on them. And we've seen a lot of that in 2020. It's like, how do you manage?
Crazy.
Yeah, how do you manage a lot of those those concepts or positions?
Interestingly enough, so you mentioned trimodality, right? And what you would say is that I'm just going to throw out a really rough number here, so nobody hold me to it. But let's just say for easy reference, 99% of the time, VIX is in what you would call a reversionary state, right? It's the trades that you're making are by definition convergence trades, right? And what that means for anybody not quite as familiar is that you've got a price that has wandered out to its extreme ends of its normal range, and you're expecting it to converge back toward a more normal price, right? And so 99% of the time you're saying that's how VIX is. And it doesn't really matter whether we're in a low vol regime or a high vol regime. So that's what you would consider the bimodal portion, right? Low VIX regime has one mode or one peak where the structure wants to revert back or converge back to that mode. And then in a high vol regime, like we'd see in like a 2008, 2009, and more recently, it'll want to converge toward that point. And then you have that third mode, right, that you refer to. And yes, it's a third mode, and it's also described as the divergent regime, right? Because the most tricky thing about VIX is that occasionally it stops being mean reverting and it goes divergent. And it does it for very short periods, but when it does it, it's incredibly damaging to those who don't count on it, right? And so you're looking at it and you're saying, I can't just categorize this instrument as being just a perfectly 100% mean reverting instrument, because it's absolutely certain that VIX will come back down to a lower level once it hits 80 or 90. It absolutely will. The question is could you handle the ride, right? And money management will get you most of the way there, but you have to be able to say we recognize the divergent characteristic of VIX in certain environments, and if ideally we can exploit them. If we can't exploit them, let's make sure that we're not vulnerable to them to a devastating extent.
Get out of the way of that VIX moonshot. So it's the reason why we really love the VIX arbitrage trade, because you could take advantage of both convergent and divergent trades. And there's very few trades that have that. Most mean reverting pairs trades are going to be convergent all day long. They don't have a divergent element to them, and only really the VIX has that divergent element in a way, which
absolutely
adds to the uniqueness that you've been highlighting. I'm curious that we had a really unique and you haven't probably seen it even in the entirety of your career. In 2020, you have the March 2020 sell-off, and so you have this echo of volatility coming into Q4 of 2020, and then we had this kink in the VIX curve due to election volatility or perceived election volatility.
It was absurd.
It made really difficult trades because you had high contango and then high backwardation around the event. It's if you haven't had that in your data set, how do you model that?
Well, you don't model it. And I'm not going to pretend that we had a fantastic time through that period. That was a very strange period. To see that kink propagate itself for months through the curve. One learning experience you have, and algos have to learn. There's no way that we can build something back in July of 2010, in my case, build it up to that and just say it's going to sit here and operate with no improvement on at the time was 4 years worth of data, right? I've got 4 years worth of data and it's a perfect system. No. So now we're getting up to where we have a larger data set. And that was actually a really nice addition to the data set, because we're saying you can't even categorize in standard deviation terms what that kink looked like. It was representing prices, relative prices, that there's no way to say whether it was a 4 sigma, 5 sigma, 6 sigma, 10 sigma event. You don't even know, because you can't actually categorize it in normal sigma terms, right? It was that absurd. And most people didn't even know it was happening unless they were plugged into the volatility world, because in the equity world, there was what you would consider a pretty ridiculous rally going on. Looking back on it, you start hearing reports about the SoftBank trade and all of these feedback loops that were happening that were pushing the market higher while, simultaneously pushing volatility higher, which is a whole different story. But if it can happen, you need to be able to handle it. And for us, what it comes down to is more strict money management techniques rather than more precise modeling, because we've always taken the approach that not everything that can happen has happened. And if something can happen, it will happen. That's the other side of that. And so you look at it and you say, what is considered a devastating loss, a devastating drawdown for your particular strategy? And some more aggressive ones might be 60%, 70%. Some more conservative ones might be 5 to 10%. I don't know. But we figure that out, and that's built into our model. And then we say we run our data set to pretty really strict risk limits. And we say, this would be considered an optimal sizing for this trade. And then we back off even further from that. So the point for us is for a trade like that to blow up our strategy, it would have to go multiple times outside of its previous limits. And in the case like you referenced with August of 2020, we were seeing prices that were roughly double with their previous limits. And so that was enough to sting a little bit if we were on the wrong side of some of those trades, but it wasn't enough to blow up, right? And that's really what you have to consider, especially in a young market like VIX, is you want to make sure that whoever's running the strategy takes a somewhat conservative approach and doesn't say, look, I can make 100% a year in VIX, and then suddenly the account is zero. So
there's, as we both know, we've seen a lot of those over the years.
Yes.
How many people are making, triple digit annual returns on the VIX always. But part of that is I wonder, you're somebody that's highly quantitative, but also with a background as an entrepreneur. And so that gives you some interesting insights. And I know you follow Rentech a lot. So in these Q4 2020s, how much of it is entirely quantitative and algorithmic versus the human element of overlaying, like, my algos may not have all the data they need. There may be something wonky here. And as a human, I need to step in a little bit and reduce my risk metrics or my risk models or my position sizes. And the way we look at it is like, that's really the best model is man plus machine. We wish everybody was highly quantitative, but there are times when you may not have enough data sets in your look back where you need the human element. How do you deal with that?
Yeah. I mean, I can tell you that to a small degree, whether you want to call it a human stepping in or just a slightly greater degree of caution, that we used both in March and August of last year. And in both circumstances, what you've got is that we can run that simulation, that incredibly exhaustive simulation that I kind of drew a picture of. It should be able to tell you within the historic data set how absurd the levels are that you're seeing at the time. And what it's going to do inevitably every time is tell you that this is a can't lose trade. It's virtually certain with $1 of risk and thousands of dollars of profit potential, right? And that kind of thing, because it's not within the data set. Now, hopefully someone's done something more like what we've done, and they've gone into their model and they've fattened the tails preemptively, right? So they've gone and said, we recognize that the historic data set is not complete yet. And one key consideration there is if you generate the scatter plot of prices that have happened in the past, and you're looking at that, and you have there's little points where there's these outlier events, and I'm saying, well, with a huge, enormous data set, they might in fact be outlier events, but with a smaller, younger data set, the data set just hasn't filled in yet. It's the more likely conclusion. And so you're saying that probably those are going to happen at a greater frequency than what I think they're going to happen at. They're not outliers. And in fact, they're probably not going to be considered the outlier once the full data set is there. They're going to be considered the 3 sigma event, and there is a 4 or 5 sigma event that goes further, right? And so you're looking at that and you're saying, hopefully someone recognized that preemptively and went in and fattened the tails out of their distributions and said that outliers are going to be more common and to a greater magnitude than what the data set is suggesting. And then once you've done that preemptively, you can at least sit back a little bit and say, okay, we've already been quite conservative. But that doesn't mean, to your point of the marriage of man and machine, that doesn't mean that you don't still you can then just sit back and say, press go and let the black box run, right? You still need to come in and say, okay, there are times, allow me to reference March 2020, I don't know if others have used this term to describe it because I haven't seen anyone use it, but we talk about the commoditization of volatility in about a week and a half period in 2020. And what I mean by that is there should be a relatively, not predictable, but a relatively consistent relationship between volatility and the underlying market, right? There were noticeable times in March of 2020 where volatility actually commoditized and was being driven. The futures were being driven by supply and demand independently of one another. Okay. So what you're saying is that normally month to month along the VIX futures curve, there's a 97, 98% correlation, right? It's an incredibly high correlation. Not when they commoditize. Each individual contract becomes a commodity in and of itself. And then suddenly you start seeing these spreads behaving in not unpredictable, but definitely unusual circumstances, right? And on the one hand, it's an incredible opportunity, but make sure you still have dry powder is really the lesson there. And if you've trusted a historic data set completely up to that point, it's highly likely that not only will you not have dry powder, but you'll be past your limits by then already, right? And so some of with each one of those occurrences, August 2015 was one, February 2018 was one, March 2020 was one. You look at these and you reassess and you say, were we conservative enough? And if we were more conservative, what's the impact to the overall model, right? And certain trades might not actually be worth it once the data set starts filling in. And so the model like ours, for example, has 7 different types of primary trades that it makes, and there's nuances within those. But if you lumped them into categories, you might say 7 different types of trades. And it might be time to look at one and say, we're not eliminating it from possibility, but now that with the new data set that has extreme prices in it, when I rerun the model or when I rerun the simulation, there's so much more risk inherent in this trade now that it might not actually ever come up as being an appropriate trade anymore, right? And that's just the reality of it. Because you look at the VIX ETFs, for example, and trying to short VIX ETFs, and for many years it was basically say something like a 2-to-1 or a 3-to-1. So you'd expect 1 unit of gain and a possible 3 units of loss, right, on a spike event. And then suddenly in March of 2020, it showed its true colors and it was actually 10 or 11-to-1 loss to gain, right? And so you look at that and you say, okay, the data set hadn't filled out yet, right? And now the question is, after you've got that data set, does that short trade, that short vol trade, does it even make sense if you actually have a possibility of losing 11 times the potential gain on it? Because now you're saying, I really still want to generate at least 10% a year, but if it can go against me 10 times, that's 100% loss. That I don't know how to come back from that. So
there's so many things you touched on there that I thought were fantastic. One, no, I haven't heard anybody say they commoditize the VIX in those markets. And that's a great way of putting it, because like you said, people will say things like the correlations break down or the VIX is broken and the correlation's broken. It's not broken. It became a supply and demand market that's decoupled from the S&P. And it happens in these really stressed, unusual times. And I think that's a great way of looking at it. And that's usually, when people get smoked because they've been counting on this negative correlation, and that's what they built their models on. And then, like as you said, they always have this Minsky moment, right? The volatility has gotten so low coming into 2020 that spike is going to be so violent. It's going to be a 10-to-1 loss that you weren't expecting in your model base. So part of that, though, I'm wondering about is that, like you said, sometimes that the VIX can be commoditized and it's due to supply and demand. What we've also seen in 2020 is that we went from more of like people have said fundamentals to flows. So it's really about these real money players and those flows, which leads back to probably your supply and demand dynamics of actually the VIX curve or just options pricing in general. So we work with a lot of managers that come from a market making perspective or come from investment banks, and they're trying to model those flows. And it's more watching how those flows are affecting pricing or pinning pricing, or whether it's getting the dealer's offside and they have the gamma hedge and you get a gamma squeeze, all of those little factors, the flows. But I'm wondering, when you guys are modeling that VIX term structure, you're actually seeing the flows in real time as well, aren't you?
Yes. Yeah. So so one of the things for us is we don't like to jump in and say that we're going to try and base a decision off of flow, right? It's a difficult market to do that. And for those who have the specialty in it, I'd be interested in hearing them break down how they would actually do it. Because for us, we say, the flow dictates the outcome, but we're not flow traders. And so we're more interested in the now and what the opportunity is in the now, right? Rather than trying to say what the momentum or something might be based on different characteristics of order flow and things like that. So you would look at us and say that most of the time we're actually looking for that the relatively frequent or absolutely frequent occurrence of inefficient pricing, and then leaning more on the law of large numbers to say that I don't want to be so heavily concentrated that I could be wrong once and it would ruin me, but I want to be consistent. We're going to set our bars really high, right? And so, for example, people often mix up probability of profit with expectancy. And they try to use them interchangeably, but they're not the same thing, right? You can have something that's incredibly consistent, 99% probability of profit, and yet it's negative expectancy because the one time that you lose out of 100, it just wipes you out, right? On the other hand, you can have something that only wins once out of 100 times, but when it does, it's so huge that it's a positive expectancy trade. You think about the crisis alpha side. And for us, we actually want the best experience for the client. And the best experience for the client, in our opinion, is not waiting around for years for something to pay off huge. And it's not picking up dimes and then getting run over by the steamroller, right? The best experience is one that has reasonable probability of profit, something in the 75 to 80% range, right? So that more often than not, the trade is going to win, right? And then looking at it and saying, we're on the other side of saying, once we've got the 75 to 80% probability of profit as a minimum, we're looking at the expectancy exclusively there. And we're saying, okay, now what's the return per unit risk, right? And saying, let's make sure that this is an identified convergence trade. That's our core, that's convergence trade. And we're going to count on that convergence, knowing that there's a divergent element sometimes, right? And produce this nice, hopefully smooth, consistent return, but with significant amounts of alpha.
That's great. I think part of the undercurrent of the last second part of this conversation we've been having is the idea that, especially in volatility markets, as a volatility trader, we're trading these non-ergodic markets, and unfortunately, we have an N of one experiment that we're all running. So at the end of the day, survivorship is the greatest accolade you can have, and you guys have been surviving just fine. I mean, you've been doing this since 2004, so that's the key, right? Is at the end of the day, it's just surviving to trade the next day.
Yeah, and that's really the thing, is because let me give you an example of that. The biggest trade in volatility out there is still the short vol trade, right? So it's undeniable that the largest portion of those who are trading volatility are doing so in a manner that they're mostly selling volatility and gaining that volatility risk premium, right? And yet, if you were to jump onto some of the different indexing sites like Eureka Hedge, for example, or something like that, and you pull up their little compiled indices of volatility funds that they've put together, that's a really convenient way to look at, okay, what exists in the market actually. And you would say, well, because the short vol trade is so huge and so many people do it, obviously, if I pull up one of those indexes, it's going to be like 40 short vol funds and then a few crisis alpha funds or a few long vol funds, right? And in fact, that's not the case. You pull up those indices and you find out, well, actually, there's only like 4 or 5 constituents in the short vol fund or in the short vol index. And then there's like 16 in the relative value, right? And then there's maybe 6 or 8 in the long vol side. And that speaks to the survivorship problem, right? Because it wasn't that there weren't a lot of people doing the short vol trade. It's just they're all gone now, and they're gone for a reason, right? And it's not that there weren't a lot of people doing the long vol trade, because that has usefulness, but they also, most of them weren't able to survive either, because there's something to be said for not sitting around for 3 years without a gain or 4 years without a gain. You do. The entrepreneur in me says you still have to generate a profit and generate revenue each year, right? And so it speaks volumes that the relative value trade is the largest of those constituent indexes. And you look at them and say, okay, what is it to the relative value trade? Well, in fact, I would argue that the relative value trade is where the alpha is generated primarily.
Yeah, it's a great way of putting it. It's like the short vol traders blow up, the long vol traders bleed long enough that they get all their AUM pulled. So they're the relative value where you want to be sitting as an entrepreneur. So I'm going to ask my last question, and as always, I'm fascinated by little details. And at the top of your pitch deck, you have the quote by Oscar Wilde: To expect the unexpected shows a thoroughly modern intellect. So that must mean a lot for you to put it on your deck. So why did you put it in there?
It goes back to that not everything that can happen has happened, right? I'll veer off a little bit. So we've all heard the quote, there's the known unknowns and the unknown unknowns, right? And all that kind of thing. That's really common. It's maybe a little cliched at this point, but I'm going to throw one at you and we say, there's the known unknowables. Okay. That's the part that's missing from that quote. And the market actually does two things all of the time. One is that it doesn't expect something that hasn't happened before, but those things are going to happen all the time, right? So first of all, expect the unexpected. That's rule number one. And then on the other part, it's the known unknowables that the market thinks, or it's the hubris, right? And what I mean by known unknowables is when you study VIX long enough, you start realizing, let's reference back to that kink in the curve in around the election season last year. And you say, that's what I would call a known unknowable. Because the reality is that all of those people who think they know that there's going to be some type of volatility there don't know that there's going to be volatility there. It's like saying, I know that this upcoming season on August 27th, there's going to be a hurricane that makes landfall in Houston, right? And you're saying there's a chance that could happen, but if I'm running an insurance company that's insuring homes in the area, I'm certainly not going to build that into my premiums and say that I know that this event is going to happen. But the volatility markets do that all the time. They execute trades based on a known unknowable, and it provides huge opportunity for those of us who jump in and say, this thing that you're suggesting that you know is going to happen is an unknowable. You can't possibly know it because no one could possibly know it to the certainty that you're implying with those prices. So I'm going to take the other side of that trade. And you might be right, but most probably, if we ran this simulation 1,000 times, we'll come out on the winning side of that. So on the one hand, you say, exploit the known unknowables. And on the other hand, anticipate the unexpected. And both of them are a question of hubris, right? Don't ever get so confident and arrogant as to think that you either know the future is going to happen or you know that something is not going to happen.
Yeah, I probably use epistemic humility too much, which makes both of us no fun at dinner parties and when we're always questioning everybody's knowledge base. But I thank you for coming on. I really enjoy that you shared your story with us, and I love what you guys do at Sirtezza. And we'll provide links and everything in all the show notes. But thanks again for coming on, Brett, and sharing with our audience, and we appreciate it.
Yeah, thanks for having me. I enjoyed it.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutinyfund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.